Hello everyone, Tony here. US equity markets closed modestly lower last week as trade tensions resurfaced on Monday and intensified throughout the week, culminating with new US tariffs on Brazil, Canada, Mexico, and the EU effective from August the 1st. The modest falls last week likely reflects the view that tariff threats are mainly a negotiation tactic by the Trump administration to put pressure on trading partners to finalize trade agreements. If in the unlikely event there is no reduction in the tariffs announced last week, it would see the average tariff rate rise to nearly 25%, up from 3% at the start of this year. Now, this would have major implications for growth, inflation, and consumer and business confidence. Looking ahead, aside from monitoring tariff headlines, this week's focus will be on earnings reports from companies including JP Morgan, Goldman Sachs, Bank of America, and Netflix. There will also be keen interest in the CPI report for June, which is expected to show core CPI rising to 3% year on year due to the impact of tariffs. Let's take a look at the charts of the Nasdaq and the S&P to see where they are as we start the new week. Okay, to refresh, we see the decline between February and April as a correction, and we're now looking for a five-wave advance in Elliott wave, an Elliott wave, five-wave advance from the April lows. Now, we can see there is three waves currently. You can see wave one, wave two, and wave three has gone a little bit further than we expected. That is not unexpected from a wave three. It is the most dynamic and the most impulsive part of the move, and it will often continue further than everyone expected, which is one of the reasons why we don't try and short it. But we do like looking or trying to find out where it might have topped out, because we then look for a wave four pullback as a potential buying opportunity. How do we know that a wave four is underway? Well, in this particular instance, for me, a break of the lows we saw last Monday coming in around 22,580-ish would be a good sign that we have maybe topped out, building in confidence if it was to break below the lows we saw at the beginning of this month, coming in around 22,400-ish. So a break below here, at the very, very least, I'd expect a pullback towards the old high around 22,000 with scope into this region here, which is also being reinforced by the 200-day moving average. So this, to me, is a buying area here before another leg higher. Now, my view will stay the same in that respect unless we were to break on a sustained basis below the 200-day moving average, currently sitting around 20,750-ish. Now, for the S&P, the wave count's much the same. You can see a wave one, this leg higher, wave two, and this is wave three. Wave three is starting to look like it's running a little bit out of momentum. You can see the RSI not confirming the new highs here, and that has me now looking at a really important short-term layer of support coming in around 61.80. So a break below 61.80, I think, would give us a good indication that potentially we have a medium-term top in here at 62.90 and that a wave four pullback is underway. Now, at the very least, I'd love to see the pullback come into this 6,000 area, which is also being reinforced by some highs over here around 59.70, 59.80-ish. Of course, you've got this 59.43 low. And below there, you have the 200-day moving average coming in around 58, 57. So these are the levels which we're hoping to see the S&P delve into. And this would be then, providing we start to see this pullback as being corrective, signs of potentially it running out of steam down here, that would be a good sign, potentially set up for a wave five into the second half of this year. Thanks for listening and have a great week ahead.